number 2. There I am. Okay.
Oh, it shifted over. Oh, yeah, that's right.
It shifted.
Yeah,
this way I can hear myself.
Right.
Hear myself think.
Excellent. Excellent. Okay. Are you ready?
I'm ready.
Let's do it.
Me and Go Girl are ready.
Sorry. Okay. Here we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money. Let's see. Our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show.
Pretend like you've done this before.
I know. I can't believe I've
7.5 years.
Yeah. Well, we weren't doing the tanning certificates for 7.5 years, but still. I should have not been screwing around with that the verbiage for a while ago.
Yeah, there we go.
Okay, so the certificates are not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. In fact, with this weather, everyone needs to get their tan on. You can't do it with the sun, so you got to go to the tanning salon.
I'm feeling awfully pale these days.
Yeah, I know. So I got to go back to them. Now, today's trivia theme is science, and these questions are hard.
Oh, thank you. You're going to embarrass me again.
No, well, some of these questions I don't think a lot of people would know, but they're kind of fun. All right. So, Mark, let's...
it's been a couple of weeks since I've been on the show. For those of you who've been listening for a while, pretty much Edward and I were on every show for most 7.5 years we've been doing this. But the last 6 months, I wouldn't call it a sabbatical, but I've gotten pretty busy in traveling and in the growth of our company, Pacific Private Money. It's required me to really go out and do more traveling, get in front of more capital resources. Kind of my role for the company is to bring in business and to bring in capital to make loans. And that's brought us to places like, to Florida, to New York, to even Martha's Vineyard to speak in front of a group of some uber wealthy family office folks. And anyway, it's been hard to be here on a regular basis, and so I really appreciate Nam Phan, my head of investor relations and marketing and business development. He's been doing a great job. I've been listening to the show and enjoying you guys, but now I'm here. You and I, we're going to talk a little bit of real estate and the market. We're going to talk 2017. We're going to talk a little bit about 2018. And so in preparation for the show, I went to my favorite websites and blog posts. And one that I pulled out for you all here, which is kind of interesting, is this is a report about a Zillow report, or it's an article about a Zillow report. It says value of housing market in the U.S. increased at its fastest pace in 4 years. And so what they're talking about is the overall market in the United States, which is really, as you and I know, Edward, real estate's local. And even local, it's neighborhood by neighborhood. So it's really hard to, when you're talking about national or nationwide figures, it's almost like, ho-hum. It's really kind of meaningless to whatever your particular real estate strategy would be. And all of us, as we invest in real estate, what is your strategy and where is your strategy and what markets are you going after and, what are your goals, et cetera. So how does it really, how is it relevant to us, an article like this that says the U.S. has home prices has increased at its fastest pace in 4 years. And so why I'm bringing this up is I find it really interesting that we're at what many believe to be the tail end of a relatively long business cycle. And we've watched real estate prices now, they've been going up now for, what we say the bottom of the market, at least in California, was probably around 2010. So it started trending down, and 7 was the peak.
I think even 11.
End of 6, beginning of 7 was the peak. They trended downward for about 3 years, sometimes 3.5 years. So sometime between 2010 and 2011, we were kind of bumping along the bottom. And then all of a sudden, whoa, we've been on a wild ride for the last, 6-7 years. And many, and if you're looking at how they define a recession, we have been in a quote unquote recovery, although some might argue about that term a little bit, but we've been in recovery for nearly 10 years now. So we're, this is a long cycle. Long in the tooth, and so we're all those of us, and no matter whether you're a stock market investor, real estate investor, a business owner, we're looking ahead and going, okay, well, when's the next recession? When's the next cycle? Because we know it's not a new universe. It's not like a new market where we wiped out recessions and business cycles and all that. No, we're going to have another business cycle.
I don't think Trump's going to allow that.
We're going to have another, we're going to have another real estate cycle, and it's going to flip from a seller's market to a buyer's market. We just don't know when. So here I'm looking at this report, and so in 2017 we've seen prices in the U.S. increase at its fastest rate in 4 years, and I just find that interesting in a couple of ways. Number one, there's no sign that that we're at the tail end. Number one, and number two, the rest of the country is really starting to catch up with what we've already been experiencing in California. I mean, if anything, in California, we're starting to level off a little bit, or I should say, the rate of appreciation appears to be slowing down. Although I'm going to share some Case-Shiller statistics on the San Francisco Bay Area in the next segment, which might suggest that maybe it's not slowing down so much. So there's just a lot of stuff going on in the real estate market in terms of housing shortages, a lack of new inventory being built, strong and pent-up demand for housing, and the fact that mortgage rates are still relatively low. They're still in the 4s, and all of that is conspiring to keep housing prices strong and increasing in most markets throughout America.
And do you find that California seems to lead the way in most of these trends?
I do believe it has. It certainly did in this current cycle. Although we're no longer the leader in market appreciation in California, there are other cities that for the last year have been appreciating faster. But certainly we were the first. We were the largest MSA to recover and experience rapid price appreciation.
All right. Very good. Okay, we're going to cut to our first commercial break. When we come back, Mark will continue with not only the statistics, but I want to get his feel for, because an email came in about 2018, what the outlook looks like. All right, first trivia question has to do with science. With what is sulfur and charcoal mixed to make gunpowder?
What was it mixed with?
Yeah, so there's a third element. Call 888-912-1190 to answer that question. And don't touch that dial. The Best of Investing will be right back. What you guys doing for New Year's?
We didn't do anything. We just stayed home. We just, we had a great meal and played games and hung out. And Lisa was asleep by midnight.
Yeah, Eva was asleep by 8 p.m. Even Sarah went to bed at 10.
Yeah.
It's actually kind of nice though, didn't have to fight any traffic or craziness. All right, you ready?
Yep.
Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf, president of Pacific Private Money. First trivia question. With what is sulfur and charcoal mixed with to make gunpowder?
No idea.
Saltpeter.
Oh.
Yeah,
okay.
you heard it? And guess how I know that? Yes, sirree. We made that when I was a kid. But I kind of looked it up. There wasn't an internet.
Boy Scouts or that gang you used to have?
I think what we did was that back then you had an encyclopedia because there was no internet. Before we continue, I do want to make a quick mention here for the Alcatraz cruises. So right now, if you buy one, you get one free. They have a buy one, get one free ticket promotion, which is available on select dates through February 7th. So that's coming up here pretty soon. Alcatraz Cruises has partnered up with several waterfront amusements with special offers and discounts. So check that out. sfwinteronthewaterfront.com to secure your coupons and instructions, or visit alcatrazcruises.com for tickets to The Rock. You ever been out there, guys?
I have. It's awesome.
It's awesome.
Yeah.
Yeah, it's a very good time. Okay, let's continue on.
So I talked about an article from Zillow saying that overall United States housing prices are now increasing at their fastest pace in 4 years, and that pace is 6.5%. That's how it looks like we're ending 2017. And there's also a quote in here says, despite recent changes to federal tax laws, which of course are making homeownership less of a tax incentive in high price areas like California, they seem to believe that the long-term dynamics pushing up home values and rents are unlikely to change significantly in the next year. So their 2018, at least Zillow's 2018 outlook is pretty bullish.
So, question, because I don't know, I saw just a little snippet, so I'm not going to really make a real announcement per se, but I will say this. There was something about California wanting to basically stick it to the federal government by saying, well, rather than not being able to deduct your California taxes on federal, they'll somehow reclassify it as a contribution.
They are up to
like
something
that.
sneaky. I didn't bring that article in with me, but we'll talk about that maybe next week because that is very interesting. That's worth looking up.
Yeah.
So let's talk a little more about the San Francisco Bay Area. Okay. So for years now, I have been watching and recording the Case Shiller. It's now called it's funny, I guess that this company has been purchased several times over. It's now called the S&P CoreLogic Case Shiller Index on housing prices.
Okay.
And what I like the most about Case Shiller is that rather than use something silly like the median price, which if we have time in the show, I'll rail why I think it's so ridiculous.
In other words, if you had a $6 million house and a $100,000 house, the median price is $3 million.
Yeah, the Case Shiller uses a 90-day weighted moving average based on price per square foot, and they've got a really great methodology, and they're one of the strongest and most widely followed indexes of home price appreciation. And furthermore, they will look at the individual MSAs, the individual cities like the San Francisco Bay Area. Although they call it the San Francisco Index, it's really the San Francisco Bay Area, several counties within San Francisco. And so a year ago, we were at around a 5 or 6% annual rate of appreciation in the San Francisco Bay Area. 2 years ago, we were at 10%. So we had trended down from 2015, which was, in 2016, we ended the year at around a 10 to 11% annual appreciation of San Francisco Bay Area home prices. In 2017, that rate fell from 10 to 9.8765. There was for several months around May, June, July, the index on an annualized basis was in the low fives. And what's interesting is it's actually trending up again in the San Francisco Bay Area. So the latest month that we have, it's a 60-day lagging indicator because they have to collect a lot of data. It takes a while to put that data through the little crunch the numbers and put it through their algorithms and spit the number out. But that as of October, that number is 7.7. So let's call it 8%. So it's actually trending back up again. That's just it. That's the analysis that I would love to see from them. I was not able to find any reports to indicate why we went from, let's say, a 10% down to a 5%. Now we're back up to 8%. Again, I'm finding it curious. It's not because of the fires, because again, this data is older. But what's also interesting is that you can really dive into the Case Shiller numbers because that 8% number itself is a blend of 3 tiers of home prices in the San Francisco Bay Area. Basically a lower tier, a mid tier, and a high tier, and their low tier is defined as any home under $700,000, and the mid tier are homes priced between $700,000 and $1.1 million, and then the high tier is over $1.1 million. And what's interesting is the high tier pricing are appreciating at about a 5% rate, and that goes with what a lot of realtors are telling me. The high end has been slowing down, but the low and the mid end, so basically for homes up to $1.1 million in price, they're appreciating at a 9% rate.
I wonder if it's the millennials that originally were very much like, who cares about owning a house? I'll just go ahead and rent. Maybe they're seeing the price appreciation, they're jumping on board, and that's causing it. I don't know.
It could be. I mean, I'm not thrilled. I would love to see home price appreciation sustain at closer to a 5 to 6% range, which is the national average. You know, the fact that some of these are back up to the 9% range just gives me concern. It's just going to be really hard to sustain that level of price appreciation.
Yeah.
But knowing that, it's again, it goes back to, you know, when's the next cycle? Well, the numbers would indicate, if nothing else, they're actually, you know, going back to an increasing appreciation rate from a lower appreciation rate. So anyway, you know, for someone who's like our company, who are lenders, you know, we look at this. These are important numbers for us to be following, and you know, we base our lending decisions based on what we think the exit strategy is going to be for that especially real estate investors like flippers and those who are investing in.
Okay, and that's going to lead into the deal of the week. You have a couple of very, very interesting deals of the week to talk about. So audience, you're going to want to listen in on the next segment for sure. All right, here's our second science question. How many feet is a fathom? All right, that's our question. Call 888-912-1190. If you're the first caller with the correct answer, you're going to win that tanning certificate. That's good. It's worth almost $100 because you can use it on various tanning features. All right. How many feet is a fathom? All right. Don't touch that dial. The best of investing will be right back. I don't know money. This is a long segment. It's 9 to 10.
The next one?
Okay. Yeah. This is where we... Well, we already kind of touched on the deal of the week with, 2018. So we should, or not deal of the week, I'm sorry, email. So we should probably have a different email. I know.
This is the third segment, the long one, right?
Yeah.
Okay.
All I can think about is that bacon. Oh, well, that's a great job.
No, I'm just going to buy one for myself.
How could you not buy one for yourself?
I know. Just,
They make me feel guilty. How about if I think about you every time I have a... I'll then invite you over and make you a bacon sandwich.
Yeah.
All right, ready?
Yes.
Okay. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Hanf. Here's a science question for you. How many feet is a fathom?
7?
Close. 6. Not bad. Okay, that's not bad. Yeah, I mean, who would know, right?
Yeah.
Unless you're a nautical person. Okay, so Mark, first of all, I do want to get into an email here, which will lead into like a deal of the week. Okay. Question is, why is Pacific Private Money getting quality deals compared to other private lending companies? So this must be an investor who has checked out the quality of your loans compared to other companies, because there's other companies out there that kind of throw a bunch of crap against the wall and see what sticks.
Okay, so I'm not going to disparage other
good point.
Private money loan originators. There's a lot of them in California. There's a lot of them in the Bay Area. And many of investors that invest in Pacific Private Money's trust deeds invest with other companies. The key to having quality loans that you can offer to your investors as investment opportunities is to have volume. That's the name of the game. Deal flow is the golden goose in our industry, in the alternative finance industry. The way you get deal flow is you market like crazy, and that's what we've done for the last 10 years, number one. And number two, we also are going after a underserved and often ignored market niche that many alternative lenders in California avoid like the plague, and that is owner-occupied, especially like owner-occupied purchase loans. And the reason that other alternative finance providers in California avoid owner-occupied transactions is because it requires additional licensing, and there's more risk on the lender being categorized as a predatory lender because we charge high interest rates, and so you have to do things like do calculations of their ability to repay, their ability to afford the monthly payments. So there's a lot of predatory lending practices that we have to avoid, and there's different disclosures, there's cooling off periods, there's all kinds of stuff that's going on legally that differentiate a business purpose or investment purpose loan versus an owner-occupied loan. So we do and we love doing owner-occupied purchase loans for a certain class of borrower, and we get those deals through our relationships with mortgage brokers and realtors. And so where I'm going with this, the question was, how come you guys have so many high quality deals? Well, what's interesting about the owner-occupied loan demand in the alternative financing space is it's generally a well-qualified borrower who just ran out of time. So we see, as opposed to, let's say, a lot of guys who are contractors or flippers, for the most part, and I've been lending to guys like that for years. So in fact, that was 100% of my business in the 2010, 11, 12, 13 was really lending to flippers, and they tend to have hammered credit for lots of different reasons. But and some of them are less than top-notch borrower quality, let's just say, in terms of their payment history and et cetera.
Ergo, the lower FICO scores.
Yeah, exactly. So, but these owner-occupied purchase home transactions that we've been doing, it's about 30% of our business right now. It was 30% of our business in 2017. And almost without fail, those borrowers had high FICO scores. Almost, in fact, I think 70% of our FICO score borrowers are over 700. Even though we're not FICO score driven, we love high FICO scores. And many of them are over 800.
Well, a lot of the reason for that, not only does it show that they pay their bills, but from an exit strategy, they'll be more qualified to get a conventional loan.
Well, and that's just it. So going back to the volume, when you're a company, when you're an alternative finance provider like Pacific Private Money, and the phone rings a lot, it's anywhere from mortgage brokers, realtors, or bankers calling with a referral, which, by the way, tend to be the highest quality lead.
Yeah, sure.
Or it might be someone smiling and dialing or emailing on the internet who's looking for, they're blasting out their situation looking for a loan. Those direct from the borrower loan inquiries oftentimes are lower quality.
Sure.
They're people that aren't represented by a broker and are just trying to find money for themselves. And again, sometimes we get great loan requests directly from borrowers, but for the most part, if you had to generalize, those tend to be lower quality. We also get leads from some consolidated lead distribution services, which some of which we quit because those are like almost the lowest quality of leads. Those are the ones that they figure, well, if I call 100 borrowers, someone's bound to say yes. I'm sorry, 100 lenders. Yeah. If we call 100 lenders, someone's bound to say yes. So at Pacific Private Money, our phone does ring a lot, and because it rings a lot, we get to look at a lot of deals. We get to say no to a lot of deals, not because they're bad people, but we just we like what we like.
You're risk averse.
We're risk averse. We have people refer to it as what's in our wheelhouse. Well, what's in our wheelhouse are people that need to close quickly, but they also want to pay us off quickly. They have an exit strategy in mind. They're either going to sell the home or they're going to refinance conventionally. The typical exit strategy for loans that we make at Pacific are a conventional refinance, and we can verify that that's a real goal and a real strategy, not just someone that says to me, well, yeah, my FICO score is 500. I'm going to go for credit repair and then conventionally refi. And that is not a strategy. That's a wish.
Yeah,
that's easier said than done, and we know that because we've fallen prey to that years ago. I mean, you learn the hard way in all business, right? You make mistakes, and you get scar tissue, and you.
But even when you made a mistake, so you didn't lose money.
No, we never lost. That's the good news about our track record of Pacific Private Money is after 1,400 loans that we've made over the last 10 years, over 400 million in loans, we have never had a loan lose money on the payback where the investor lost money.
Yeah, so even if you, quote, made a mistake, maybe you needed to extend the loan.
Well, the mistake is it was just it was a borrower that couldn't get out, and now we're struggling to help them get out.
Yeah.
And oftentimes just look, your only strategy is you got to sell the property, and oftentimes they want to hold on to the property because it's got equity or for whatever reason.
Or maybe they'll dial 100 more new lenders.
Yeah. Well, and we got a loan request this week, in fact, that we're working. In fact, Edward, you and I talked about this deal. It's from. They have a loan that's maturing and it's private and they want to get paid off and they need to pay it off because the existing lender is threatening to file a notice of default. And the problem is the owner of the property is on a fixed income. It's a low fixed income. The rental income is only a certain amount, and the amount that she needs to borrow to pay off the existing loan at the rate we would need to charge, they would be underwater financially. In other words, our loan payment would be like $6,000 a month, and they only bring in about $4,500 on the rents. And anyway, it's not a good sign. But this person doesn't want to sell the house, and so what we said is, look, if you list the property for sale, we will make you a bridge loan so that your current lender doesn't file a notice of default. And put you in even further jeopardy of having to fire sale your house and lose some of your equity.
Plus the loan to value is still under 70%, and you've got impound of mortgage payments for a year.
If we were a loan to own lender, we would just make the loan and just say, hey, well, if you can't make the payments, tough luck. This is I didn't say this at the beginning. This is a non-owner occupied rental property, so the regulations are different. They're more favorable to the lender. So we could make that loan just because they're asking for it, and then if they don't make the payments, foreclose. But again, we're not in the business of doing that. That's not our preference. So we would rather them say. So we basically said, look, we'll make you the loan, but you got to list this with the broker and actually sell.
Gotcha. Okay, we're going to get to a break, and we come back. We're going to talk interest rates. All right. Third trivia question: Angora wool is produced from what animal's coat? Not 888-912-1190. Don't touch that down. We'll be right back. Start to run over just a little bit. So let's talk about the fund, the interest, like that kind of a loan, what kind of interest rate you charge. Benefits the fund.
We also talk about the 100% financing on documented alimony too. Yeah. How many minutes on the next one?
It's also a long one, 9:17.
Okay.
Didn't have to. I mean, some of the commercials I had expired last week, and I couldn't get it.
Okay.
You okay?
I'm good.
Good.
I burped off the air.
Yeah.
You didn't hear that.
Yeah, exactly. Live streaming. They had John Kingdon in the sports one earlier today.
Yeah.
You don't know if you know him, but he.
Yeah.
You don't know Kingdon?
Oh, no. I thought you meant your buddy who comes in, the Olympic medalist.
Oh, Paul Kingsman.
Yeah.
So, but John has been involved with the Raiders for many, many years.
Yeah.
Player personnel, stuff like that. And he accidentally swore, and I. Just a little bit, but it was enough that I had to go, oh crap. Oh crap.
Gosh darn it.
Oh. Didn't drop too big a bomb, but enough for me to have to go, don't do that, no more. No more. All right, ready?
Yeah.
There we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf. Third trivia question. Angora wool is produced from what animal's coat?
I should know my goats, but I don't remember the name of that one.
No, actually, it's Angora rabbit. There's a rabbit called Angora.
I thought it was one of those spitting goat things.
Oh, yeah, that's what I like, a llama or something like that. No, I was kind of surprised because I've heard of Angora, sweaters. I didn't know there was an Angora rabbit. All right.
Politically incorrect to wear one of those.
I was going to say it's very cold right now. Okay, so there was another deal that you wanted to talk about because usually you do 70% or less financing, but it's loan to value. But in some cases, you can actually go higher than that.
Well, where people get confused in alternative financing is that there's a loan to value ratio that we solve for when we make a loan. And we've often said on the show, we solve for a loan to value ratio of 70% or less. But what we've also said that what we can do in alternative financing is something the banks will not do. It's one of the reasons why, in fact, many of the loans we make have cross collateral, meaning we've got more than one property. So we can make a loan to you in an amount that is equal to, or sometimes even greater than, 100% of the purchase price of the loan you want to buy. So we can provide 100% financing to acquire a target property if you have other property that you can offer up as collateral. So now we make a loan that's secured by 2 properties, sometimes even 3. So we've crossed over 3 properties. So here's a story. We're not going to get into a lot of details on this, but essentially the person who contacted us is divorced. And what's interesting is they did one of these very simple do-it-yourself divorces, and there's $6,000 alimony being paid from the ex-husband to the ex-wife. The ex-wife wants to acquire a home and found out that undocumented $6,000 a month doesn't work for the bank. So they went to an attorney that's now documented, but she has an opportunity to buy a home now. And so they came to us, what can you do? So we looked at the situation, and the house that they want to buy, we can make them a loan that's equal to 100% of the target price of that property, because the husband has offered up his property as additional collateral. And when you add up the equity between the cost of the target property and the equity in the new home, the loan amount that we would make this woman is equals to about 40% effective loan to value. So this is actually a really good loan. We're still doing our due diligence and making sure that we're not going to run afoul of any ability to repay or any other regulations. But again, it's a situation where if you're a real estate professional, you might be a mortgage broker or a realtor, and you have a client that maybe they have all their equity tied up in their existing home, but they don't want to sell it first before they buy their next house. Or there's a situation like the one we just described where they need 100% target financing, but they've got additional collateral they can put up. They just need to find a way to acquire the property. And once the property is acquired, it's a lot easier to get her to refinance that loan with a conventional financing.
Yeah, because they can now show that they've paid 6 months or 9 months worth of mortgage payments on that.
Right.
And in fact, in that case, I remember your underwriter saying that they actually went to court just to be able to document the fact that now there's real alimony, rather than just a very amicable off the record type.
Right, exactly. So it's interesting, the situations that we hear about sometimes, and this was a first. This is the first time we ever heard of undocumented alimony, but it's just there's all kinds of strange situations that people find themselves in. And it's certainly not the norm. And again, we're alternative financing. We're a plan B when plan A fails. Bank financing is always going to be the best financing to get when you need financing. It's always going to be the preferred financing if you can get it in time. The reason people come to Pacific Private Money and companies like ours is because they either have run out of time, or the bank won't do a creative acquisition loan to them. They don't like multiple properties as collateral. They typically don't do cross collateralization. So that's why. Okay, so
I'm in the audience and I'm listening to this. This sounds like a great story, but how does it benefit me, the listening audience, if I say, well, that sounds really good for you, for Pacific Private Money?
Yeah.
How do I get to benefit that if I'm going to?
Well, so we have 2 types of clients. We have those who come and borrow money from us, and then we have investor clients as well. So all of our capital, 100% of our capital that we use to make loans to people like the 2 examples we just gave is private capital. It's from private individuals who have chosen an investment strategy which is in the alternative investment category. Alternative investments include things like investing in real estate, or investing in trust deed secured notes, or investing in a mortgage pool fund. At Pacific Private Money, we offer 2 types of investment strategies. A mortgage pool fund strategy, where it's a very it's an easier, friendlier way to invest where you don't need to have experience in note investing. We also work with experienced note investors who prefer to be more in control and invest in notes on an individual basis, either fractionally or whole notes. We do both. So you can invest in notes directly, or you can invest in a mortgage pool fund where we control the loans that that fund invests in. And we pay our investors on average right around 8%. That's a fairly typical yield that you'll get. And that's as a result of note rates that tend to be around 9%. So we tend to charge the borrower 9.5%, sometimes 8.5%. It fluctuates, kind of depends on, the borrower variables and the property variables and the loan to value, et cetera, but between 8.5% and 9.5%. And that's been trending down. That's down year over year from, it used to be between 9 and 10, now it's 8.5 to 9.5%. That's pretty consistent throughout California on the borrower side. And on the investor side, that's been trending down a little bit. We work with investors who remember the good old days where they got 10% on their money when they invested. And that may come around again someday as interest rates increase. But right now, the typical yield that a note investor or a mortgage fund investor will see is going to be between 7 and 9%, and we're paying right around 8%, a little bit more than some, a little bit less than others. The ones that we say a little bit less than others are usually the ones that are doing riskier type loans, because we're just not seeing the 10% note rates anymore. Those borrowers are out there, but again, our wheelhouse is we like the stronger borrowers with the strong exit strategy. We like conservative loans. We like surety of execution on the loans. That's our strategy. Short term, 1 year or less.
And 8% is nothing to sneeze at.
8% is nothing to sneeze at. Could you make more on your money? Yeah, you can look around, but again, it's if you want to work with a Bay Area company that loans on Bay Area real estate, that's run by people like myself who have over 35 years experience in Bay Area real estate, both from the investment and the lending side of things. You should give us a look and take a look at our inventory. One thing I will mention is that in the fourth quarter, which just ended, we launched a new initiative for our investors to be able to go to a new platform to buy individual notes rather than have to call us and wait for the email to come with a note buying opportunity. We have a new website called privatemoneyloans.com. I know that Nam and you, Edward, have been talking a lot about this website over the last several weeks. So privatemoneyloans.com. It's still technically in beta. We're still kind of getting our inventory up on the platform. But that's going to be a growing resource for our investors to be able to log in anytime on their phone or their laptop or their tablet and check out opportunities to invest.
Great. Don't touch that dial. Investor Investing. We'll be right back.
I can't.
Oh, true. Yeah, we can.
Yeah.
Okay.
I'm out of practice.
It's true.
So I can do my rant on median price.
Sure. We've got
for the last 5 minutes.
5 minutes, yeah.
This time I will start this silly thing. How much time do you like? Where do you like me to stop at for that? So if I give you
4:10.
So 4:10.
Yeah.
Okay. All right. I'll talk for 4 minutes and 10 seconds.
Okay. That works. I just want to quickly have you just quickly finish off, but people can still sign up for private loans. Okay. Well, welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hanf. Now, Mark, you finished off the segment talking about your new website, or this additional website called privatemoneyloans.com. Even though it's still in beta, people can still register, right?
People can still register. You need to register to use that. Again, that's kind of the format. All of the crowdfunding type of sites, which is private money loans, is similar to many of the other crowdfunding sites that allow you to invest in notes, although we are offering actual notes, not platform notes or promises to pay, like corporate debentures. This is actually you investing in actual notes. So if you have any questions or want more information or want to talk to Rick or Nam or myself about note investing, we're happy to talk. We spend a lot of time every week talking to new potential investors. Give us a call at 415-883-2150. We're right here in the Bay Area, 415-883-2150. You can also check out our website, our corporate website, which is pacificprivatemoney.com. That's pacificprivatemoney.com. I wanted to end the segment. I got a couple more minutes here to do my annual rant on the median price. So we live in Marin County, and the local paper here every month comes out with blaring headlines about the median price is up to this or up to that. It's up 17% year over year. And people, there is no such thing as a median priced house. There is no median house. The median price is a statistical point which fails to work in any kind of real analysis of what home prices are selling for. What you want to do is which is why I follow the Case-Shiller index. The median price it's right in the middle of where 50% of the homes have sold for a lower price and 50% of the homes sell for a higher price, but it changes monthly based on the mix of homes that sell, which are always changing. Maybe 1 month more lower priced homes sold than higher price. That'll bring the median price down. Again,
so if you have a house that sells at $3 million and a house that sells at $100,000, your median price is $1,550,000, right? If there's only one house of each that sold,
right? And in counties like Marin, not that many units sell per month, and because of that, the median price jumps wildly all over the place.
Sure.
And the problem is that the reporters, most of them know this, and yet there's something about the newspaper media that continues, month after month after month to report the median home price and how much it's changed on a year over year or month over month basis, and it's just silly. So really, if you want to have a true feel for where home prices are tracking, you want to go to CoreLogic's site because they are the ones that now own the Case-Shiller index, and they every month they report on the trends. They have an actual index that that started out at 100 and now it's up to, I think it's 247 in the San Francisco Bay Area. So you can watch that trend, and it does an analysis of the year over year moving average for home price appreciation, much more accurate. So anyway, it's my little rant on. I wish these guys would stop reporting that. It seems so easy to go to Case-Shiller and look at their reporting procedures and not be so misleading about it. Because otherwise, you read these articles, they come out every month, it's like, so we're up 17% year over year. It's like, not exactly. My home didn't go up in value by 17%. So anyway, median price. I guess they're not listening to me, but if you're listening to us on the Best of Investing, we'll tell you what's happening in real estate in California, in the San Francisco Bay Area, and we will also tell you what's happening on the investing side in mortgages, where you can earn 8% on your money.
And we'll never lead you astray.
Absolutely not.
Go ahead. Last time, give your information.
So pacificprivatemoney.com. All of our email addresses are on the website, or give us, as is our phone number, 415-883-2150.
All right, we're going to cut out for today. Here's our thoughts for the day. Surrender to what is, let go of what was. Have faith in what will be, said Sonia Ricotti. I don't know who that is. And sometimes you win and sometimes you learn. I like that too. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. That's it. Stop broadcasting. Stop it. Stop it right now.